Insurance-covered attacks. Cyber insurance policies typically cover a range of cyber attacks, and the specific coverage can vary based on the size of the business and the specific risks it faces. Data breaches. This is one of the most common types of cyber attacks covered by cyber insurance. It involves incidents where sensitive, protected, or confidential data has been accessed or disclosed in an unauthorized manner. Cyber extortion. This includes ransomware attacks, where a type of malicious software threatens to publish the victim's data or perpetually block access to it unless a ransom is paid. Network security breaches. This covers incidents where an unauthorized individual gains access to a company's network, potentially leading to data theft or damage. Business interruption. This covers losses that a business may suffer due to a cyber attack that disrupts their normal business operations. Privacy liability. This covers liabilities resulting from privacy law violations or cyber incidents that expose private data. For large corporations, these policies often include coverage for third-party liabilities, such as costs related to disputes or lawsuits, losses related to defamation, and copyright or trademark infringement. For small businesses, the coverage may be more focused on first-party losses, such as costs associated with notifying customers of a breach, paying legal fees, and hiring computer forensics experts to recover compromised data. Businesses often need a combination of both first-party and third-party coverages to be fully protected against the range of cyber risks they face. First-party coverage in cyber insurance policies. First-party coverage in cyber insurance policies is designed to cover the direct costs that a business incurs as a result of a cyber incident. Business interruption. Loss of income and extra expenses incurred due to a cyber event that disrupts the business. Cyber extortion. Coverage for ransom payments made in response to ransomware or other cyber extortion threats. Data recovery. Costs associated with recovering or replacing lost or corrupted data. Notification costs. Expenses for notifying affected individuals, customers, or regulators following a data breach. Credit monitoring services. Costs for credit monitoring services offered to affected individuals after a data breach. Public relations. Expenses related to managing the company's reputation in the aftermath of a cyber incident. Forensic investigation. Fees for experts to determine the cause and extent of the cyber breach. Third-party coverage in cyber insurance policies. Third-party coverage is liability coverage that protects a business against claims made by others, clients, partners, etc., due to a cyber incident for which the business is held responsible. Legal defense costs. Fees for defending against lawsuits related to cyber incidents. Settlements and judgments. Costs of court verdicts or settlements resulting from such lawsuits. Regulatory fines and penalties. Coverage for fines and penalties that may be imposed by regulators following a data breach or cyber incident. Media liability. Protection against claims of intellectual property infringement, defamation, or invasion of privacy due to electronic content. How do first-party and third-party cyber insurance policies differ in terms of premiums? The premiums for first-party and third-party cyber insurance policies can vary based on several factors, and the difference between them is not typically standardized across the industry. For first-party coverage, premiums are often influenced by the type and amount of sensitive data a company holds, its industry, the robustness of its cybersecurity measures, and its history of cyber incidents. The more extensive the potential direct costs, such as business interruption, data recovery, and crisis management, the higher the premium is likely to be. Third-party coverage premiums, on the other hand, are often influenced by the company's exposure to liability risks. This can depend on factors such as the nature of the company's operations, the extent to which it handles or has access to third-party data, and its contractual obligations related to data security. Companies that provide technology services or handle large amounts of third-party data may face higher premiums for third-party coverage. How do first-party and third-party cyber insurance policies differ in terms of deductibles? The deductibles for both first-party and third-party cyber insurance policies can vary based on several factors, including the type and size of the business, the level of cyber risk it faces, and the specific coverages included in the policy. For first-party coverage, the deductible may be influenced by the potential direct costs to the business from a cyber incident, such as business interruption, data recovery, and crisis management costs. A business with a robust cybersecurity infrastructure and a good track record of managing cyber risks may be able to negotiate a lower deductible. For third-party coverage, the deductible may be influenced by the business's exposure to liability risks. Businesses that handle a lot of third-party data or provide technology services may have higher deductibles due to the increased risk of third-party claims. In general, higher deductibles result in lower premiums, and vice versa. Therefore, businesses must balance the desire for lower premiums with the ability to pay a higher deductible in the event of a claim. It's important to note that the specific deductibles can vary widely between insurers and individual policies. Businesses should carefully review the terms of any policy they are considering and discuss their needs and risk tolerance with their insurance broker or agent. Factors affecting premiums for first-party cyber insurance policies. Several factors can affect the premiums for first-party cyber insurance policies. Type and amount of data. Companies that handle large amounts of sensitive data, such as personal information or credit card details, may face higher premiums due to the increased risk of data breaches. Industry. Certain industries, such as healthcare and finance, are often targeted by cybercriminals and may face higher premiums. Cybersecurity measures. Companies with robust cybersecurity measures in place may be able to negotiate lower premiums. Past incidents. Companies with a history of cyber incidents may face higher premiums. Revenue. Larger companies with higher revenues may face higher premiums due to the greater potential financial impact of a cyber incident. Coverage limits and deductibles. Higher coverage limits and lower deductibles typically result in higher premiums. Factors affecting premiums for third-party cyber insurance policies. The premiums for third-party cyber insurance policies can also be influenced by several factors. Type of services provided. Companies that provide services involving access to third-party data or systems may face higher premiums due to the increased liability risk. Contractual obligations. Companies may face higher premiums if they have contractual obligations that increase their liability in the event of a data breach. Industry. As with first-party coverage, certain industries may face higher premiums due to the increased risk of cyber incidents. Past incidents. A history of cyber incidents or claims can result in higher premiums. Coverage limits and deductibles. As with first-party coverage, higher coverage limits and lower deductibles typically result in higher premiums.